Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastori. Today is day 3 of our Sustainable Investing Focus Week. It is an immersive educational experience designed to help you learn more about how best to incorporate sustainable investing into your overall wealth plan. I have the pleasure of being joined once again by my colleagues Ainsley Carbone and Justin Waring, both with the Chief Investment Office. Ainsley, nice to have you here. Justin, good to see you. Thanks for joining us.
Thank you for having us.
Of course, anytime. We have a lot to get to. Ainsley, we often talk about the 3 L's of the UBS Wealth Way, which is liquidity, longevity, and legacy when it comes to building a portfolio. But we want to talk about it today because it's Sustainable Investing Week in the context of SI. So maybe you can kind of give us, again, that background on what the 3 L's are and who they're helpful for and in what way.
Absolutely. So the liquidity, longevity, legacy framework segments wealth according to specific needs and specific time horizons. So the liquidity strategy is for your near-term needs, longevity is for your lifetime needs, and legacy is for the needs that go beyond your own. So maybe it's philanthropic objectives or you're looking to transfer wealth. One of the benefits of this framework is that it can be customized to your specific situation. So, for instance, in your working years, let's say your paychecks are coming in, they are enough to support all of your day-to-day spending needs. So you really probably only need an emergency fund in your liquidity strategy. And your savings that you're adding to your accounts is really directed towards your longevity strategy. There you're probably making contributions to a 401k or an IRA for your retirement spending in the future. Whereas in retirement, the liquidity strategy has a much more meaningful purpose because you no longer have those paychecks coming in that are funding your day-to-day spending. So you're going to need to rely on your portfolio to fund your spending needs. So at that point, we recommend having 3 to 5 years worth of your spending needs in safe assets in that liquidity strategy. And what that does is it gives you the confidence that you're going to be able to meet your needs regardless of what's going on in the market.
Right.
So since the relative size of the portfolios, of the strategies change over the course of your lifetime, it becomes a strategy or an investment approach that allows you to manage your wealth regardless of where you are in your life.
Terrific. Ainsley, thank you. And I know we've spoken about this a lot, but Justin, let's, Ainsley's talking about investor objectives, and of course, they're tied to the UBS Wealth Way, but this week, as we have been focusing on sustainable investing, one of the big questions is how investors can reflect sustainability in their portfolios. What would you say are some of the main ways that we're helping investors incorporate sustainable investing into their portfolios?
Well, the good news is it's never been easier to incorporate sustainable investing into your overall investment strategy. So in fact, we designed a suite of strategic asset allocation models that help you incorporate SI into every line item of your portfolio. So these models have very similar risk and return characteristics as a traditional portfolio and can be a great one-stop shop for investors that are looking to invest sustainably. But if you aren't looking for a 100% SI portfolio off the shelf, you can also cater the investment strategy to your preferences by using individual sustainable investing building blocks, such as ESG leaders, which invest in companies that are ahead of the curve on implementing sustainable factors into their business practices. These building blocks can often be switched one for one with traditional investment strategies without affecting the portfolio's expected risk and return. And actually, this is a notable thing right now because both stocks and bonds are in the middle of a temporary sell-off. So this is actually a good time to shift your portfolio towards sustainable investing at the same time as you reduce the impact of capital gains taxes. To make this work, the first step is to look at your portfolio for tax loss harvesting opportunities. So these are positions that are trading below your purchase price with an unrealized capital loss. When you sell these positions and realize those capital losses, it'll help you offset your tax bill this year and in the future. And then you can use the proceeds from the sales to add to sustainable investing building blocks or make other changes that'll help you reposition your portfolio for the market recovery.
Great, thanks, Justin. It's always good to put it into context of a real life situation, like you said, with taxes, certainly something we can all relate to. But I want to dig a bit deeper with you, Justin. How should investors think about allocating to some of these SI strategies in each of these 3 categories, the 3 L's we're talking about here? And let me dig even deeper than that. What are some of the key considerations when deciding how to incorporate SI in the liquidity strategy as opposed to longevity or legacy?
Well, it's definitely possible to incorporate sustainability into each of the three L's. As I mentioned earlier, there are sustainable investing building blocks that can be used to implement each part of your portfolio: cash, bonds, stocks, and alternatives. For the liquidity strategy, you mostly want to keep to cash and bonds because capital preservation is key, and you want to finance day-to-day spending for your portfolio without having to worry about what the market happens to be doing that day. But using these building blocks can make it very easy to transition each of your 3L strategy portfolios into sustainable investing while keeping your asset allocation and your risk level consistent. But for investors who are looking to beyond just simple replacement for traditional investments and looking to capture the upside potential driven by long-term secular trends or focused on a particular area of sustainability, these could be implemented using sustainable and long-term themes. And most of these investment strategies and themes can be appropriate for either the longevity strategy or the legacy strategy because they are usually implemented using a portfolio of publicly traded stocks and funds. Impact funds are the most notable exception to this rule. Impact funds generally make it easier to drive intentional, measurable, positive impact on environmental and social issues, and they're much better at tracking this impact, but you have to lock up your capital for 7 to 10 years. Because most families have longevity and legacy assets that they don't plan to spend for decades, a legacy strategy and a longevity strategy can both implement impact funds and other private market investments because these funds are not needed in the meantime, and they could afford to take on that illiquidity to potentially capture a higher expected return, or like I said, to get a more measurable impact on environmental and social issues.
Right. Thanks, Justin. Yeah, and it really is about understanding the values or incorporating the values that you and your family have when thinking about investing sustainably in your own portfolio, because it really is a very individual experience. So let me ask you, Ainsley, as we're wrapping up here, what is then your advice, since we've gotten all this great information from you and Justin already, for people, for clients, investors who want to incorporate SI into their own investment strategies?
So Justin just gave some general advice for really the whole population. But if you're looking to implement a strategy that's specific to your unique situation, then I always recommend you have to speak with your financial advisor. And what they can do for you is they can first help educate you. Any additional information that you're looking for, any introductory content, they can share that with you. They can address any questions that you may have. Once you feel like you have that knowledge that you need in order to start incorporating a sustainable investing approach into your portfolio, then the advisor can work with you to help uncover any of your sustainable investing interests or preferences. And then at that point, the advisor can work with you to identify the appropriate sustainable investing approach that's going to align with those interests, match those interests and preferences, and they can help you incorporate that into your portfolio so that your overall investment portfolio is still going to be on track to meet all of your needs.
Excellent. And I know advisors have different tools where they can actually filter out the things that matter to you so you can be investing in funds or companies that match your own values. So that's really great advice. Ainsley, thanks very much. Justin, always good to have you join us from a remote location. And Ainsley, good to have you here in the studio. Great. Thank you both.
Thank you.
Great. Good to see you. And for more information on anything we discussed today, you can visit our main website, ubs.com/views. Plus, we've got lots of information on our social media channels: LinkedIn, Facebook, Instagram, Twitter. Plus, check out all of our past UBS Trending episodes on demand on our website and on the UBS YouTube channel. And in the meantime, if you have any questions, as Ainsley said, make sure to reach out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. Remember to keep your eyes on what's trending. We'll see you soon.